Excellent. Thank you. All right. Well, good morning, everybody. Thanks for joining us. Today we have Mark and Greg from Rational/Catalyst Funds. Met these guys, I guess, a few months ago. Mark caught my eye with a webinar he was doing that he's going to present today. And it's going to focus on, I think, hosting client events and how that can be beneficial to your practice. I know we've had a handful or more than a handful of business reviews with the folks in the group this year. And something that seems like it's not getting done a whole heck of a lot is client events. Now, there's nothing wrong with that, but Mark, I think, is going to put a fresh perspective on it. And I know we do still have a local group here that does a lot of client events, and that really feeds their pipeline and feeds their practice, new prospects and clients month in and month out. So not to mention, they also have some pretty good funds that I think they're going to talk about as well. One fund that we are utilizing here at Premier, maybe actually two now that I think about it. But I will let them take the floor here where they'll talk about their practice management and their product, and take it away, gentlemen.
Yeah, appreciate you taking the time, everybody. Welcome. As Sebastian mentioned, Mark Aldini here with Catalyst and Rational Funds. My partner, Greg Torty, on the call as well. We cover Eastern Pennsylvania, cover South Jersey, as well as the state of Delaware. But yeah, we'll go right into things. As a firm, I guess I'll cover a little bit now, and then we could get into some of the highlights later. But basically, we partner with hedge fund managers, private managers, and bring their funds to market in the open-end mutual fund space, oftentimes recognized as liquid alternatives. We also specialize in fixed income, and that's without any K-1s or funky tax reporting, no accredited investor requirements. These are liquid daily, just like traditional open-end mutual funds. We partner with some top firms across the globe, BNP Paribas, one of the largest institutions over in Europe. We are in the process of partnering with Goldman Sachs as well, so really looking forward to that partnership. Milburn Ridgefield Corporation, not a household name, but they've been running hedge funds since the 1970s. CIFC Asset Management started from the chief credit officer at JP Morgan back in 2005. Mostly institutional. We have the only retail product that CIFC offers, one of the largest credit managers here in the United States. So a lot of great things happening. I know fund selection is not always top of mind, however, so we think it's good to generate some business building ideas. I follow a lot of social media influencers, financial advisor influencers on social media. LinkedIn, YouTube has a ton of great resources. So packaging that up and being able to digest it in a format that you all can utilize in your practice. So I'll just get right into the presentation here, share my screen. And feel free, if anybody has any questions, don't hesitate to stop me as I'm walking through this. And certainly we'll open it up to questions afterwards as well. So here is a proven method to get in front of 720 high net worth prospects annually. That's with minimal time, effort, and cost. So as Sebastian mentioned, it is a combination of event and COI marketing, centers of influence marketing for advisors. So we'll go over lots of cool events. We've got golf, happy hour, wine tasting. Before we get started, I'll introduce you. There might be a little bit of a lag here as I'm changing screens. But I'm going to introduce you to the Oxley Institute, and you'll have this website. They've been doing research on high net worth prospects since the 1970s. So lots of great resources, over 45 years of research and over 60,000 subscribers. You can go to their website, Oxley.com, Oxley Institute, it might be, and actually enter your address for free to get a weekly newsletter. And they also have like over 100 different podcasts, so great resource. And what's neat about this, a lot of the topics that they review are actually covered with events, specifically with centers of influence. So you're getting personal introductions at your events. You're socially prospecting to invite those to your events. Clients are advocating for you because they're having fun at your events. You can use digital marketing. You can also tie in educational seminars. These are, it's really left up to you if you want to make it more of a social event or an educational seminar. But you can see how many of these topics are actually covered when you utilize events with centers of influence. All right, so we'll go into an advisor case study. A friend of mine who is also a wholesaler out in the Pacific Northwest, Matty D. Ferdinando, he has a client that utilizes this exact process, and he actually shared it with us. So first and foremost, thank him for allowing us to use this. The tactic is to partner with 11 local small business owners and organize 12 social events per year. So it'd be difficult if you were to do one event per month. It'd be a little bit overwhelming, but we're way more likely to handle one event per year or even one event per quarter, depending on how many local small business owners you partner with. And I'll go into some examples later on in the slides, but each small business, say they invite 5 people, that could fluctuate depending. Perhaps you have more than 5 people, but take that across 12 small businesses at each event. That gets you to about 60 times 12 months out of the year. That's where we come up with the 720. And the results here are actually pretty amazing. So to actually convert 30 new clients, you don't need a very big kind of turnover. If you have 720, it's just a small amount of those prospects to turn into new clients. And the best year our advisor had in this case study brought up to 40 million in new assets under management. And we'll go into some of the lifetime value and the ROI later in the presentation as well. And say you were to do events, I know Sebastian mentioned there might be some events going on within the OSJ, and inviting your clients, they're much more likely to advocate for you, much more likely to refer you to their network. But you're not really getting in front of that many new prospects at the event itself, unless they're inviting friends, of course. So this is why we want to partner with centers of influence, COIs. You're going to be able to, of course, minimize the time and cost. You're going to meet new people, share new referrals. We'll go into some tactics and ways to do that. And last but not least, have lots of fun. And how to identify your COIs. So of course, you can ask clients for recommendations. LinkedIn's a phenomenal tool that you can utilize. And then working with your current COIs is a great way to identify them as well. So here is a sample email you can send to your clients. Of course, if that's approved by your compliance, always want to check the box first with compliance on any of these recommendations. But just using some direct response copyright, you can ask them, do you know any small business owners, ? Let them know you're putting together fun events, baseball games, give them some examples here, and see, do they happen to know any small business owners that are looking to grow their business and might be up for partnering on events. And in the PS, you could ask them for recommendations on event ideas that they might like to attend. Of course, there are no bad ideas here. And then we'll also go into some more of those possible events you could utilize as I'm waiting for this screen to change here. A couple of pro tips, you can add these items. So as you're meeting with clients, just simply ask them what events they'd be interested in attending. And again, you could ask them what small business owners they might know who are looking to expand. I know right here in my apartment building, one of my neighbors, they own Al Fresco's Cantina, a Mexican restaurant here in Astoria, Queens. I see them all around town. They seem to happen to know, everybody. Their license plate even says Al Fresco's on it, and they opened up a second location. So if someone were to ask me if I knew any small businesses locally that might be willing to host them for an event, El Fresco's could be a good example and a recommendation that I'd give. Say you were to do like a Cinco de Mayo event in May, that could be where they, might come up as a good recommendation. So finding small business owners on LinkedIn. If you're not too familiar, you can search for keywords on LinkedIn like small business, entrepreneur, startups. You can also search for variations of job titles. You could also use hashtags related to small business, hashtag entrepreneur, hashtag startup. And since you are a small business as a financial advisor, it would make sense to join some of these relevant groups, connect with other members. Oftentimes they do meetups and expand your network from there. You could also search for specific small business owners, chiropractor in Iowa, CPA in Warmslyburg, estate planning attorney in Mount Laurel, dentist in Harrisburg, for example. And you could also ask your current COIs. I know a lot of advisors, they work with CPAs, they work with estate planning attorneys. So you can ask them, what small business owners do they currently know? And you could help them replicate the same process. If it's okay for you to share these slides with them, share some of these talking points, you could expand on this further with current businesses that you partner with. And here are some more examples of small businesses that you could potentially partner with. CPAs and estate planning attorneys, of course, mortgage brokers, real estate brokers. You're going to want to focus on those who tend to have more high net worth and more affluent client bases. I really like the property management. If any of you, are familiar with 1031 exchanges, property management companies tend to own properties themselves, and this could pose an opportunity for a 1031 exchange. I also like the winery owners, the brewery owners, restaurateurs. They tend to be looking to fill up their venues on like a Wednesday or Thursday when you'd be doing these events. And potentially you can get a free venue out of the deal as well. So just some ideas here. Monthly event calendar. We'll go into some examples. I know I mentioned a couple already, but say for January, you could do like a wine and a wine tasting. Many people don't want to be outside if you're in a cold area of the United States. Going inside for a wine tasting could be a good way to celebrate the month of January. You can make it fun and do like a blindfolded wine test where maybe the winner gets a small prize. For all our lady advisors out there, you can do one specific for your lady clients, or nonetheless have a Galentine's Day in February, a March Madness in March. So on and so forth. I really like the advisor here who ties in a local charity, local veterans charity, Bowling Pins for a Purpose. So you can possibly slice that how you like, potentially tie in a local charity to your events as well. And here are some of the results, the lifetime value that I mentioned we'll review. So the cost, if you look at this, spread out the entire year, each small business is going to split up that cost each month, right? If you were to leave one business to each month, that leaves more opportunity for somebody to skip a month, or if you're doing this maybe on a quarterly basis to get started, it's good that all your small businesses have skin in the game for each event. And that way it's cost, less expensive, less than $500 per month to bring in 30 new clients and potentially 40 million in assets under management. We ran through the lifetime value of this. $6 million over the course of 20 years could be up to $300,000 annually. So I know a lot of employees and key employees cost upwards of 100 grand per year. For less than $6,000 per year, it certainly makes sense to consider this as a part of your marketing budget. And some of those benefits that we discussed, that 6 million, we did the ROI over 1,070% return on investment. Continued referrals from your COI group, There's Barron's Hall of Fame advisor, John Cutton, who's famously known for utilizing centers of influence in his business. And he says the key is to get referrals from your COIs. You want to stay top of mind, right? Rather than staying in touch maybe once or twice per year, stay in touch quarterly, monthly, even weekly, and doing events with your local COIs almost guarantees that you're staying in front of them on a monthly basis as you're talking about events that you have upcoming in the pipeline and who you're inviting, asking who they're inviting. So that could be a good tactic to utilize as you're doing these events. You're more likely to get referrals as you stay in touch with your COIs. Of course, small business owners supporting each other, the community and local charities, which sometimes I think we don't do enough of as a whole, at least I know myself, and building new relationships across your network, building your book, and having lots of fun. So that's the presentation. Hopefully you all found value, and this will pause here and open it up for any questions.
I just want to say that if Mark piqued your interest, you can reach out to him individually and discuss any questions or comments or anything you need clarified.
Yeah, thank you, Greg. I also have done other presentations in the past. Did one a few months ago on how to potentially raise assets under management. Just did one about 2 weeks ago on how to get more email responses. And I have one in the pipeline on how to get AI to recommend your business. I know that's been a hot topic, so should have that done shortly.
I'll just add a quick comment, guys. Just a reminder to the advisors in the group. I know that, obviously planning an event can be a lot of work. And just remember that, Premier is willing to help out and do some grunt work and operational work to help, get that done, whether that's invite or helping finding a venue. We're ready and willing to help out with those situations. So just let us know if that comes up.
And Sebastian, let us step up. We're willing to provide marketing dollars also to help you offset costs. So we're looking to partner up going forward. So we have dollars for you, gentlemen and ladies. Thank you.
Thank you, Greg.
Yeah, that's a good point. Usually I mentioned in the presentation, I think I breezed over that. Of course, as wholesalers are known for helping with those types of events, some other small businesses also have vendors who could perhaps pitch in as well.
I have a question or at least a thought. Hi, this is me
Hey,
talking.
Tom.
So it's kind of merging the idea of COIs with business circles. So I'm in a very niched market, so I wasn't even sure whether it makes sense for me to kind of be at this presentation. But what I'm gleaning from it was I could have social events and make sure that I'm teaming with small businesses or other organizations that are related to the same niche that I am, which is special needs families. So it would be a little odd, but like for me, like a top golf event where I'm going to maybe team with Special Olympics or some other sports related social service organization or for-profit organization that's working with special needs people or things like that. And so you can design these things, kind of like, yeah, a combination of sort of a, business circle. In a previous life, when I didn't focus on special needs so much, I guess a better example would have been like a business circle for new families with babies, and you go to, your business circle is Bye Bye Baby and a local pediatrician, and just all the same people that are servicing into that same niche.
The combinations are endless. It's just
Right.
how creative you are. Tom, good
Right.
point.
Yeah, that's a great idea. So some of the examples that I gave on the slide of small businesses to partner with, definitely not limited to that. And I think focusing on, like you mentioned, some that might specialize in the same areas that you do could be very powerful, right? Because they're all looking to get in front of similar target markets. And I love that. I might consider adding that to my presentation.
Nice. Mark, now dazzle them with our funds and our performances.
Yeah. So, as I mentioned, we partner with private managers, hedge fund managers. We also do have a few in-house managers as well. But the specialty is a lot of these strategies you typically can't access within an open-end mutual fund format. And if you can, sometimes they have really high net worth requirements or high minimums, which we do not. Typical minimums of open-end mutual funds at 2,500. But a lot of our strategies fall into basically the category of equity-oriented, hedged equity or some type of quant type strategy, and non-traditional fixed income, depending on how you categorize high yield or senior secured loans, mortgage bonds. But they've been doing really well over the last handful of years. I'll kind of go into our flagship. Let me pull down this presentation here. Our flagship Catalyst Milburn Hedge Strategy Fund. As I mentioned, that's sub-advised by Milburn Ridgefield Corporation, and they date back to the 1970s. This exact strategy actually goes back to 1997. So it has a very long track record, a proven manager, And I'll share my screen again here. So I get this queued up. And feel free if anybody has any questions as I'm running through this presentation, don't hesitate to stop me. So you want to get that in presentation mode. I won't go through all this, but as I mentioned, they go back to the 1970s. Universe of over 150 different types of markets that Milburn can trade. So it's highly diversified across the globe. They're looking to bring uncorrelated return streams and kind of be flexible, as many of our strategies are, to not only play offense and give you upside in a rising market, but to play defense and protect in more of those like prolonged periods of stress. Of course, those like quick reversals or market shocks, those could be challenging for any portfolio, but those structural bear markets like we've seen in 2022, back in the tech bubble, the housing crisis, this exact strategy was actually able to generate positive returns during those times. We have about 11 billion in assets under management, actually here as a firm and Milburn, coincidentally. So the strategy, how are we able to play offense in a rising market? About half the portfolio is always going to be long only equities. And then when we protect on the downside in those bear markets, that's a long short futures component combined all into one portfolio. So you may be familiar with managed futures. They have a good history of protecting in those markets that I mentioned. But in a bull market, they tend to lag severely, and clients oftentimes wonder, why am I owning this thing? And combining those futures markets with a long only equity bucket kind of gives you the best of both worlds. They use various different types of data. I won't go too much into this. I don't want you guys to fall asleep here, but these are some of the markets that they're utilizing: interest rates, currencies, stock indices, energy markets, metals. That's all on the long short side, about 100 markets or so, and combined with their long only equities, up to 150 different markets. So highly diversified. The correlation's about, it's less than 0.5 to the S&P 500. And we were able to generate over 10% annualized return going back to 1997. So I promised we'd keep it pretty high level. Here are some of the return streams that I mentioned, outperforming the S&P over 28 years or so. We've had 4 down years, which is pretty good. Our worst down year in 2011 was 7.5% roughly. The other down years that we've had were like pretty much flat, maybe 0.5. And then we had a 2% down year in 2018. And that's with across 5 different bear markets. 5-year rolling returns and a 3-year rolling return. I like this slide because it shows the importance of holding this long term. If you look, as I mentioned, those quick reversals and market shocks tend to be a challenge for really any portfolio that goes long or short. And that's why it's important, like for the Liberation Day that we saw more recently, the regional bank failure of 2023, again, challenging environments. But when you hold this for 3 years, we've only been unprofitable 2% of the time on a monthly basis, any 3 years across the 28 years we've been in existence. And if you hold it for 5 years, that's profitable 100% of the time. So the strength in holding this, you give us 3 to 5 years, we're going to perform. Also on a 10-year rolling basis, that number of profitable periods is 100% as well. This looks at our performance on a quarterly basis. So if you took the 15 worst quarters of the S&P 500, going back to 1997, there's been about 15 here, and there were only 2 times that we underperformed those 15 worst quarters. To no surprise, it was during those more kind of shocks in the market. So when we look back to Q1 of 2020, that was during the pandemic where we underperformed. And then also going back to the 9/11 crisis was the other instance, I believe was It's in here somewhere. The 2001. Doesn't look like it, but it was more of those market shock type of environments that we did not outperform the S&P 500. This gives you an idea how we could perform in certain market environments. Extreme bull markets, we do well. Upward trending markets, structural bears, of course, and then, as I mentioned, the market shocks could be a challenge for us. So that's pretty much it. We go into some monthly numbers here. Might be valuable for me to send this along to you all. That was just a quick highlight of our flagship.
Mark, if I can jump in and add a little color.
Yeah.
I love the Milburn product. I say it's the ultimate diversifier with only 4 down years and 28, 29 years of existence. It is 100% systematic. It's really a math and science fund. It's driven by algorithms. Your ETFs are going to be static and long only, but for my money, you do 100% managed futures fund, you might wait 2, 3, 4 years for the over performance. Our performance streams are a little bit more predictable. We've been underperforming the market for the past 2, 3 years, but if you go back to 2022, the market was down 18, we were up 7. Wouldn't you like to have a diversifier in your portfolio that gives you some upside lift in a otherwise, bad market? And that's the value proposition there. And as far as eating your own cooking, when you do meet Mark and I, if you walk to the back of my car when we're going to lunch, you'll see my license plate, MBXIX. Is the cornerstone fund of our firm. And for my money, you want to do a hybrid, diversified 2 pools of money, one in the managed futures, the other pool in the static long only ETFs. It gives you a much more predictable return stream. And Mark already said it. If you give us 3 to 5 years, we're going to give you market-like performance, but we're going to do it a different way. We ask that you have client control, because if you have people in your practice, if the market's up and we're slightly down, they're going to be calling you and bothering you. I don't want you to experience that type of situation. But if you have great client control, when you do your reviews, this is why we own this product. You quantify it, you justify it. And then years like 2022, they're calling you up and say, wait, why don't we own more of that MBXIX? But, you have to do your proportions or your allocations and stick to them. So that's just a little color. The other thing that's beautiful about our firm is we're flat organization. If you have interest, you contact Mark and I, and we put you right in touch with the management team, and they'll do a granular drill down to the minute aspects of their deep machine learning, if you go for a view of their offices, their whole trading floor is amazing. There's no humans on it. It's terminals, and they ding when the trades are placed. Now, a human does check off on every trade, but like I said once, I'll say it again, this fund is 100% systematic, so it makes it unique. It takes the emotion out of investing. Sometimes we get a little grumpy when we say there's a predictable event and when you go to the other side of the trade, and they say our long-term track record suggests when you do 100% systematic, you don't get whipsawed. We see other junior or neophyte managers out there, they jump to the other side of the trade too early, the market corrects, and then they get whipsawed. We try not to play that game. Consistency, they stand on their 28, 29-year track record. I have never seen these gentlemen that manage the Milburn product get nervous. No matter what volatility is in the market, they believe in their process, their practice, and they're just a stability story. And the track record, if you go back to 1997, only 4 down years, there's something to it. Mark is a young buck in the industry coming up with all these great marketing ideas. Unfortunately, I've been around since 1987, so I've seen a lot. My first year was the market crash of 87, where we went down 500 points, represented 40% correction in the market. If the market goes down, 500 points today, it's not even a blink of the eye. So everything's changed with ETFs, with automated trading, and this is a scientific product that keeps you relevant and adds diversity to your otherwise long-only equity portfolio. So I think it's a great addition, and it pretty much works for every client. Even though it's managed futures, because it's so diversified, my call is we could only own one fund. This may be the fund, because you're going to get, all those areas of managed futures, and with the ETF exposure, you're getting global exposure with those static long-only ETFs. Those are my comments. Mark, if you want to continue.
Yeah, you bring up a good point. And, with markets at or near all-time highs, the Buffett indicator at, I believe, 200 and the Cape Shiller at 40 for the first time since like the tech bubble. Those forward-looking return expectations could be a little tight for equities. There might be room for us to run. It's really hard to say with AI and tech. The difference between the tech bubble and now, some of these companies are actually making money. But nonetheless, if you look at Milburn during that like lost decade back from 1999 to 2009, we put up over 165% when the markets were down, roughly 10%. So the diversification, not only to give you some upside in a bull market, but to also perform if equities, kind of underperform, if you will. And yeah, I guess we have a few minutes here. I don't plan on staying here for the whole hour. Does anybody have any questions before I just quickly highlight some of our fixed income?
I think Jim Williams does. I see his hand raised on his.
Fire away, Jim. You're muted.
Yeah, I just unmuted myself. Yeah, I just wrote a comment. I had been doing some due diligence on MBXIX for a couple of years. And it wasn't approved at my previous broker dealer. So I just upped my game when I joined Premier over the last few months. And I just wanted to let you know I had a really great conversation with Ethan Bledsoe. And it was kind of the icing on the cake for me to go ahead and start implementing that fund.
You get star of the day. Pro V1s will be coming your way.
Yeah, well, yeah. Maybe I have golf clubs, and I kind of know how to use them, but I haven't really used them in about 15 years. So
well, your clients will love them anyways.
Yeah, there you go.
Jim, we appreciate you. Thank you. And
well, I just want to say that Ethan, I was hoping that when you started showing the charts, Mark, I'm like, oh, you better show that 28-year chart because that's the best one. I mean, that put me over when I saw that, so the one that showed the 4 years and then the 2020 number or the 2022 number that was only down like less than 0.5%. I'm like, come on now. I mean, it just seems like like Ethan had recommended, start out at like 3% sleeve and work your way up to where you think it's the right fit. And that's really what I'm doing. I'm just kind of stepping in. That's how I usually do it. Toes in, ankle, and then work my way up. So
beautiful.
Yeah. This is I'm glad that I have access to this now because I didn't have access before.
It will definitely move your efficient frontier. So that'll work.
Yeah, for sure.
Yeah, that's
right.
Great news, Jim. I thought I saw you yesterday on our run, and I'd reached out to Ethan to confirm your email, thank him for taking the time to speak with you, and we appreciate the shout out here. Ethan's been integral on our team as part of the business development side, and we look forward to the partnership working with you as well.
I will tell you that he did. I did a follow-up email, and he was kind to debunk the rumor that he was related to Drew Bledsoe, which he's not.
I always call him Drew I'm a Boston boy by birth, so I always call him Drew by accident. But
nice.
What we'll do is we'll send out the marketing materials that will show. Mark kind of skipped over that chart with the 28 years. That is really powerful. We'll send that out. I think it's on page 3 or 4 of the brochure. And once you visualize that, you'll know exactly what we're talking about if you're not familiar with the conversation that we're having right now. But
definitely send it out.
And then come back to us with questions.
Yeah, definitely send it out because Ethan had sent it to me a couple of days ago. So
it is powerful.
Yeah.
All right. So I'll jump quickly into the fixed income. I know Sebastian highlighted this as a recent implementation, and it's called our Rational Special Situations Income Fund. This has a long track record as well. It dates back to 2009. It was kind of started after the housing crisis. This is backed by pre-2008 mortgage bonds. But basically what was left over from 2008, homeowners that survived the housing crisis and are still, paying on their mortgages today. They have strong homeowner equity north of 60% with a lot of home appreciation there. And what you get are stable returns. This is, I think, 0.1 correlation to the aggregate bond index and maybe a 0.2 correlation to the S&P 500. you'll see here throughout the 15 years or so that we've had, only one down year in 2022. We were able to protect tremendously against that downside that we saw that year. And when we look at years of falling interest rate environment, like 2019, for example, we still have potential to generate, meaningful upside. 2024 is another good example of that. Might be lagging a little bit here in this environment, but nonetheless, I think it's important to see how over the longer periods we're able to kind of provide stability, smooth out the sequence of returns. And a lot of that reason is due to the nature, number one, of our portfolio management team. They're very disciplined in their approach. They focus at or near the top of the capital structure. So these are mostly senior bonds. And if you start getting down to more of those junior bonds or mezzanine bonds, that's when you could have some issues and less stability. So that's not what we're looking to do. We stay true to our nature, providing stable and consistent return streams that are uncorrelated to most markets and most funds out there. It has a great distribution on it, above 6.5%. That does fluctuate depending on the income that they get into the portfolio as they pay out whatever comes in. They also do have exposure to commercial mortgage bonds. So aside from the residential, since the COVID crisis, there were a lot of cracks that I wouldn't say were to the extent of what we experienced in 2008, but nonetheless, CMBS markets have posed a great opportunity for our managers, not really focusing on like office space. They're really disciplined and they're utilizing them for special situations, which I'll get into now. The special situations, if you could think of when these contracts were made prior to the housing crisis, there was just a lot of sloppiness, for a lack of better terms. Many of the agreements were just copy and pasted across many different mortgage pools that didn't actually represent those mortgages. And so what we find are our managers find bonds that might be paying out, instead of top down from the senior bonds down to the junior through the mezzanine, some of these bonds are actually paying out to the junior tranches first. And what they'll do, they'll buy these bonds, they'll reach out to the pooling and servicing agreement. It's a firm called Intex who prices these bonds. They let them know their findings. And a lot of times they're just a middleman. They have no skin in the game. So they'll amend those discrepancies and we'll get a nice pop in that NAV and the cash flows that were supposed to come through to the portfolio. They'll also find mispricing. So a lot of times these bonds just were priced completely incorrectly, and they'll do the same thing, reach out to the pooling and service, the PSAs they call them, get those amended. And it's a good optionality. Worst case scenario, they're left with a bond that's paying, at least 5%. And if their findings are true, which many times they are, they get that optionality of additional upside. So that's kind of the short story here. We have some statistics, as you'll see. And I'd like to note, actually, these performances that we saw in 2009 and 2010, even this in 2012, we would not expect that to be the case here in the portfolio these days. But still, high single digits, potentially low teens are what we expect in an interest rate environment that's just kind of been all over the place. So I'll stop here and see if there's any questions on this portfolio specifically.
Mark, at the end, you may want to throw up that chart that shows the 28 years, 29 years of Milburn, just so the guys can visualize it.
Yeah, not a bad idea.
Now, let me add a little color on the special situations. I also like that fund a lot. They're at the top of the credit stack, and there are some funds that outperform us in the same space. But if you look at 2022, our fund went down 0.85. I'll use an example of Alpha-centric. I'm having trouble speaking this morning. Great fund, puts up huge numbers, but if there's any volatility, they went down 40%. For my money, I do not want that type of volatility in my bond portfolio. It takes you, 7 years to come back, maybe even 10 years from that type of volatility. We want off 0.85. So there's that balance of upside versus downside. So I'd rather go for a much lower downside capture ratio and give up some of the upside. In the long term, it'll do you justice for you and your clients. I use a term, but you got to listen carefully. I say these things are self-insuring because of the loan to debt ratio of the mortgage versus the property value of the house. These bonds are not insured, but back in the day when they had the volatility, everybody's house was underwater. So if you sold it, it was a short sell. That's not a good scenario. We don't worry about prepayment risk here because hypothetically, someone's got a $500,000 house. They've got a $750,000 mortgage. They want to, sell that house. They're going to get over $1 million for it probably in today's market. So you want to watch the real estate market. That's one of the bellwethers. If for some reason we had just tremendous volatility in real estate and the economic condition and housing prices came down, precipitously, then you would, that self-insurance goes away. But right now, very stable investment, good diversifier, excellent management company, and the president of ESM is a lawyer. So we have the ability to litigate in-house, and there's a special situation going on right now that could translate to a nice pop in the NAV. It's working out. It might resolve in early 2026. It might take a little longer, but we have got some notes. They're called surplus notes that we actually got from AMBAC. AMBAC just sold a division that issued these notes to Oaktree, and they're a $209 billion institution run by Howard Marks, and they don't buy anything they can't make a profit off of. The key is he's got to pay off these surplus notes, and right now they're trading at about a 59% discount. So if he pays off those notes, we're going to get par and then some, because they were PIK bonds, which I've been in the industry for 38 years. I had never heard that term before. That's when a note is not paying interest. So it's hurt the yield of the fund, but we've accumulated more shares of that bond, or more of that particular bond. Some of the holdings that we have are 200% of par. So if they decide to pay off those bonds, that special situation fund NAV is going to pop dramatically. And there is no real downside because the dark days have already gone through of the market not really appreciating those bonds because they weren't appropriate for a lot of portfolios. Traders wouldn't buy them because they had no interest component on them, because they were hence that PIK bond. So what I would suggest with Sebastian, if we could down the road, maybe we get your people together for conference calls with the two managers of Milburn and Special Situations, and they'll do a granular deep dive and just convey, a level of knowledge that your people might need to deploy these funds into their portfolios, because they are simple, but they are very complicated. And back in the day, these were hedge funds. And if you had met me at a cocktail party and said, Greg, what do you do for a living? I'd probably get a little cute and say, I work for a hedge fund conversion company. And you guys being in the industry, you'd say that's a very provocative statement. Realistically, the value of Catalyst is the owner is brilliant. He goes to all these financial symposiums and meetings, meets a lot of hedge fund managers that can't advertise. And what he does is he converts their fund into an Act 40 fund. And we're just a marketing arm. We've got great salespeople. And that's why the Goldmans and the BNPs are coming to Catalyst, because we've demonstrated we can go out with a fledgling fund with no assets and raise assets first dollars. That is huge. So we've got non-standard, unique products that will give you more diversification, and that's what we bring to the table for you. Like I said, we're flat, we're totally transparent. You go to me, you go to Mark, we go right to management. If you want to talk to the president of Catalyst, Jerry Szilagyi, there's no glass or ivory tower here. And some of the institutions that I worked for in the past, you couldn't get above a product manager for a fund. I want to talk to the guy that's making the decisions and pulling the trigger. And that's a huge difference for us. Flat organization. And if you want to speak to somebody at any level of our company, just tap us on the shoulder and we'll get you there. Your thoughts, Mark?
Oh, you brought up some good points there. I don't think I could have said it better. One thing you did mention, the prepayments for the Special Situations Fund, which I haven't talked about in a while, but due to our average price of the portfolio being below par, prepayments could actually help the portfolio rather than hurt it as well. So that would be one more thing. And we have a few other fixed income strategies, 5-star rated. The CIFC credit manager that I mentioned with the Senior Secured Income Fund, they've done a tremendous job. the Catalyst Insider Income Fund as well. That's managed here in-house, as well as our high income fund has just been really blowing the top off its competitors. So yeah, I could send these in a email as a follow-up. Sebastian, how would you like to move forward? Do I send the follow-up to you and you could relay that to everybody?
Sorry, I realized I'm on mute. Yes, that's fine, Mark. Anything that you want us to send out, pass through us, and we'll blast it out to the group.
One
Okay.
of the other benefits with Catalyst and Rational, we have portfolio valuation services. We brought on a few gentlemen from other firms. Tyler Wilkinson's the head of that area. And as a value add, if you dovetail with us, show us your portfolio, we'll do the analytics on you and tell you where your weaknesses are and how you can achieve your Markowitz efficient frontier. So that is a free service. You know, BlackRock does that with Aladdin, and we're up to snuff with them. It's just a question of where you get that resource from. But so we're more than happy to provide that to you. So we are a value add company with excellent sales ideas. Mark is really the generator of that, financial support, and then, you know, just intelligent IQ and how you structure your portfolios for optimal results. Basket of utility, and that's our value prep to you. We're behind you. I always say we're always looking to make friends. And if you engage us, we will impress you.
Excellent.
I like it. Thank you, Greg.
All right, anybody?
Thank you, Sebastian. Yeah, if there's any more questions, we'll hang on for a couple minutes.
Anybody else? Jim, I see your hand up, or is that from the previous? It might have been from the previous stuff. Okay. All right. Well, thank you guys. Thanks, Greg. Thanks, Mark. Great stuff.
Jim had a question. He raised his hand again. He's on mute. Jim, you're on mute. Still on mute.
Yeah.
There you go.
Just a quick kind of a technical question for the Special Situations Fund. Is there a particular, target for RMBS versus CMBS? Is it, as far as the allocation goes? I mean, is there looking for a mix in these senior securitized notes, or is it, whatever's just the best flavors of the month? Or
Yeah, it's a great question. Of course, the pre-2008 mortgage bonds is a, shrinking asset class. So I think at this point it might be 60, potentially 55% of the portfolio. The CMBS is a little bit over 20%, and that's solely for special situation trades. And then the AMBAC bond that Greg had mentioned, it shows up as a corporate bond, but that is kind of a secondary mortgage bond or RMBS trade, if you will. So that's just kind of a quick breakdown.
thanks.
My pleasure.
Okay.
That might do it for us, Sebastian.
No, I appreciate you guys doing this. I told you when we first spoke, I really appreciate you guys blending practice management and product knowledge together. Clearly, you have some unique and, top performing funds, in their category. So we'll blast this out. And if anybody has questions or wants follow up, we'll certainly connect them with you.
One last thought. We have an event in November. Mark set up. It's Upper Deck Golf. We have a couple slots available. I don't know if we go through you, Sebastian, or his interest. It's going to be in Philadelphia. Mark, why don't you just spend 30 seconds on that, just to dangle the opportunity, because it's for a golfer, it's going to be an excellent time.
Yeah, that's a good point. I know many of you are spread across the U.S. and maybe not so close to Philadelphia, but if you are, or you want to make the trek out, November 13th, it's a Thursday. That's 2 weeks from today, actually. We're meeting at 4 p.m. at Citizens Bank Park. Upper Deck Golf. It's a pretty unique event where you get to, they have basically a course set up in the baseball stadium. And I think it's like a 9-hole course that you get to play for a couple hours out there. Be great fun, playing some golf, eating some food, drinking some cold beers. That is 2 weeks out. If you'd like, Sebastian, I could send you that in a separate email.
You'll be able to drive from the upper deck. So you'll be the only guy on your street or only gal on your street that can say that they've driven balls. Is it at the baseball stadium or the football stadium? I'm confused. I'm not a golfer.
Citizens Bank Park. I believe that's the baseball stadium. I could be wrong.
Baseball. Yeah.
It is, right? Okay. New York.
That's pretty cool. I've never heard of that type of event, but
come on down.
Yeah, we're looking forward to it.
I'll be watching from afar. I'm not picking up a golf club. No, thank you. Not my sport.
Okay, well, great. Well, yeah, we'll get any information you want to pass through us, Mark and Greg. We'll get that out to the group. And like I said, just appreciate you guys hopping on here. And I know we talked about our Hershey conference, and I know you guys maybe had some interest. So be good to come next year and meet some people in person, shake some hands. So hopefully we can get that done.
Sebastian, is your meeting over? Do you want us to drop off, or are you going to conclude it?
Our meeting's over. Yep. So
Great.
unless anybody has anything else, we can give you a few minutes back in your deck.
Thank you, everyone. Appreciate your time and attention. Any questions, bubble up to Mark and I, and we'll go to work for you.
All right. Thank you. Have a good one, everyone.
God
Thanks,
bless you
everybody.
all.